The Schwab US Dividend Equity ETF, or SCHD, has had a rocky first half of 2023 so far, with several banks collapsing and a more than hawkish Federal Reserve that is consistently raising rates higher and higher. SCHD hasn't been exactly insulated from the rest of the market's turbulence. To get some more context here and where SCHD is currently, in comparison to the rest of the market, year to date, SCHD is down around 5.12%. And this is total return, so this is dividends included. While the S&P 500 is actually up year to date, 8.76%. So why is SCHD getting so beat up? And why do I think that this could be one of the last great buying opportunities for investors to grab shares of SCHD before the ETF goes parabolic? In this video, we're going to go over exactly why I think this is. Right after you please drop a like on this video and subscribe for more honest, transparent dividend investing content. Backing up for a quick second, SCHD's 52-week range is $65.96 as of the low over the last 52 weeks, whereas SCHD's high in the last 52 weeks is $79.49. So SCHD currently is still towards the low end of the range. Which then brings me into one of the reasons why I think SCHD could be a buying opportunity at these current levels and or if it drops even a bit more. SCHD's current trailing 12-month dividend yield is around 3.72%. And the cheaper SCHD gets, the further the share price goes down, dividend investors like myself are going to be able to capture a nice size starting dividend yield for the maybe most popular and, in my opinion, best quality dividend ETF in the world. Now, with an ETF like SCHD that has a 5-year growth rate of 15.56%, if you were lucky enough to lock in a starting high dividend yield of around 4%, which is what investors would be getting if SCHD drops a little bit more, SCHD investors are going to see that dividend yield supercharge because of the ETF's extremely fast-growing dividend rate. Just a few years ago, SCHD was paying around 30 or 40 cents per share per quarter. A few years later, not all that long, and the dividend has nearly doubled, paying investors almost twice as much per year to own the ETF. So if SCHD was to see a new 52-week low, or even get closer to the current 52-week low, in my opinion, a long-term dividend investor like myself would be lucky to grab some shares at that price. Now you might be saying, okay, that's great, SCHD might be a good buy as of right now, and it would be awesome to lock in a huge starting dividend yield, but that still doesn't solve the problem here. Why is SCHD share price so beat up year to date compared to the S&P 500, and is it going to get worse? Looking at the holdings breakdown for SCHD, we have industrials at 17.66%. as the biggest sector for the ETF. Next is healthcare at 16.74%. Then we have consumer defensive at 14.61%. And then what do we have here? In red, very fitting, we have financials at 13.37%. Now, unless you were living under a rock over the last few months, we all know exactly what's been going on in the financial sector. Numerous banks have actually collapsed and are failing. Banks like First Republic, PacWest, and JP Morgan even had to take over the First Republic Bank after the biggest US bank failure since 2008. So where does that leave SCHD? Well, with just over a 13% exposure to financials, I think long term this is not going to make or break the SCHD ETF, and in my opinion this could mean for an awesome buying opportunity. This right here is every single position in the SCHD ETF right now. And if we look at the sector, there's only a few names that are in the financial sector when it comes to SCHD. Looking a little bit closer at some of the banks that are actually in the SCHD ETF's holdings, we have ticker symbol RF, Regions Financial Corporation, currently down 22.9% year to date, which is one of the bank's biggest drops in the last 10 years. Now what's crazy is if you look into the stats of ticker symbol RF, the dividend summary fundamentally crosses off everything that SCHD would be looking for in a holding. It has a 4.84% forward dividend yield, with a 31% payout ratio and a 17.76% 5-year dividend growth rate. Oh yeah, dividend growth has also been consistent over the last 10 years. Ticker symbol NTRS, Northern Trust Corporation, is another one that's inside SCHD. This financial stock is down 18.66% year to date. And by giving the dividend summary a quick glance, this stock also looks pretty decent. What about ticker symbol KEY? This is Key Corp, another holding in SCHD. This one's down 44.18% year to date. Now, Key Corp offers a 8.34% forward dividend yield with a 45% payout ratio and a 14.87% 5-year growth rate. So what does this all mean and what exactly am I trying to get at? I'm trying to explain the fact that SCHD does have some exposure to financials, and the financial sector has been beat up just about as bad, if not worse in some areas, than that we've seen since 2008. But with a solid list of top 10 holdings that do make up the majority of the ETF, names like PepsiCo, Merck, Coca-Cola, Verizon, AbbVie, Home Depot, Amgen, Broadcom, Chevron, and Pfizer. Solid names that have been paying dividends and increasing dividends for a very, very long time. I don't necessarily think that SCHD is doomed. And again, I think it might be a good buying opportunity. Now, what about the entire banking and financial industry? And will there be more doom and gloom ahead? Well, the Fed just announced recently, as of a few days ago, what could be the last rate hike this year. So with the Federal Reserve finally possibly slowing down on rate hikes, this is going to alleviate some of the pain in the financial sector. And until we get to that point, there most likely will still be some banks, some companies that are not well positioned that might unfortunately collapse or fail. But overall for the entire industry, I do think that there's going to be a decent bounce sometime soon here. And especially once the Federal Reserve starts cutting rates, I think the banking industry and the rest of the stock market could go parabolic. So SCHD holders are going to have to realize that there is some risk with around 13% of the fund being financials, but are going to have to ask themselves that on the other side of this whole thing, will this dip be a buying opportunity? But I want to hear from you guys down below. Do you think SCHD currently is offering a good buying opportunity for long-term dividend growth investors? Or do you think that there's going to be much more pain ahead for the ETF? If you enjoyed this video, make sure to please drop a like in the video and subscribe for more. Thanks as always, guys, and I'll see you in the next one.